Hi, my name is Daniel Kertcher, founder and CEO of Trading Pursuits, and welcome to the Trading Pursuits Market Update for January 2013. Now, before we get started, there's a couple of key things I need to share with you. Number one, what I'm sharing with you today is what we call general advice. It's not individual specific advice. Furthermore, we haven't taken into consideration your personal financial objectives. This is just general information about the overall markets. Now, no trading suggestions are being made or implied in this trading discussion. Furthermore, should you choose to trade, you need to know what you're doing. Trading involves risk. And finally, my company, Trading Pursuits, we hold an Australian financial services license to allow us to discuss these particular topics. Okay, now, welcome to 2013. Happy New Year. You've no doubt, of course, aware of what was known as the fiscal cliff. And this was the issue we had going into the Christmas season right before the new year. Now, the fiscal cliff, what exactly was that? That was a series of automatic tax increases and spending cuts that were due to come into effect on January 3rd, 2013. And that was unless Congress and Barack Obama could get together and nut out a plan where they were going to either delay or reduce some of the fiscal cliff issues. Now, the big concern about the fiscal cliff was that the tax increases and the spending cuts would cause such an impact to the U.S. economy that could send the stock market spiraling down. Now, typical in American Congress fashion, they waited till the 11th hour to come up with a solution. In fact, it was on January 3rd this year that both Barack Obama and the Congress signed through an act to allow the progress. Basically, they came to a compromise with the fiscal cliff. They did allow some of the tax increases, but they've deferred some of the spending cuts until later on in the year. Now, as far as the stock market is concerned, they saw this as a positive sign. We can see here that is the exact date, January 2nd, that they pushed through this solution, or compromise, if you like, and straight away the stock market rallied up. In fact, the stock market, the S&P 500 index, the top 500 companies in America, it's rallied now up to 1,470 points, which is a rise of about 10% in value in just the last few months. In fact, if you look at the past 5 years, you can see how the S&P 500 is now trading at the highest level it has been since September 2008. In fact, it's only about 100 odd points shy of its record all-time high. So the US stock market is certainly strong at the moment. If we have a look at US unemployment, we can see that it's still very slowly creeping down. It's down to the 7.8 levels. Overall, the market wants to see unemployment well down into the low 7s and preferably into the 6s within the next year or 18 months. If we do see that, then we'll likely see a continued rally and surge in the US stock markets. Now, this is the US debt clock, and here we can see how the US debt is now up around $16.4 trillion, and it's growing quite rapidly. Now, they have a debt ceiling issue that has to be addressed. In fact, they've already gone past the deadline. So within the next couple of weeks, you'll hear of the debt ceiling issue in the news. And they'll most likely, of course, increase the debt ceiling, allowing Congress to continuously borrow to keep the country going. Now, this has created a lot of fear. Now, fortunately, the compromise has allowed the stock market to rally, but there's still a lot of fear and uncertainty in the market. And as a consequence, here we're looking at the US government bonds. Now, bonds are typically seen as a safe haven. Investors put money into bonds. It's like putting money in the bank. You'll get your money back with a low amount of interest. So investors invest in bonds because they're too afraid to put money into the stock market or real estate or into commodities or currencies. And what we can see here is that the bond prices have been coming down over the last couple of weeks and months. Now, that's a good sign because it's showing that fear is starting to dissipate. However, if you look back at the 2008 period, right at the peak of the troubles back in the global financial crisis back in 2008, you can see that right now bond prices today are at the same high level that they peaked at back in 2008. So despite the fact that the bond prices have come down recently, showing us that fear is starting to dissipate a little bit, fear is still as high as it was back in 2008 when we had the massive global financial crisis at the time. So in other words, there's still a long way to go for fear to dissipate into the markets. If we have a look at the crude oil price, one of the most important commodities to consider for global economic growth, we can see here the crude oil price is trading around $95 a barrel. Now, if you look back over the last year, that's a pretty average price. In the last 18 months or so, the crude oil price has been up as high as 114. It's been down as low as about 75. So it's pretty average at the moment. Of course, it peaked back in 2008 around $148 and bottomed out in 2009 at 32. So at the moment, oil at $95 a barrel is a good sort of level for growth in the global economy. If we have a look at a broad commodity index, this particular index is looking at not only crude oil, but also metals such as aluminium, copper, zinc, as well as gold and silver, and commercial agricultural products such as wheat, soybeans, etc. We can see here that overall, the broad commodity index, that is commodities in general, have been pretty stable for the last year or so, pretty much going sideways. Now, Australia, being one of the biggest commodity nations in the world, not surprising that if commodity prices are pretty steady, the Aussie dollar is also pretty steady. You see, for the last year or so, it's been hovering around that 105 level. Now, the Aussie dollar has also been held up high due to our higher interest rates in Australia than we have in other countries around the world, namely in America and Europe. Now, the Australian stock market has been performing quite well. Just like the US stock market's rallied up about 10%, so has the Australian stock market. However, if you compare back to the highs back in 2008, we've still got a long way to go to recover from those highs of 2008, unlike the US market, which is almost back to its all-time highs. And finally, we have the US yen. Now, those of you who've heard me speak before, either in the live events or in these online videos, will be aware of my discussion of the US yen. This is one of the biggest movers of the last few weeks and months, in that the Japanese yen has dropped in value enormously, meaning that the value of the US dollar against the Japanese yen has shot up. In fact, it's the fastest performing currency of the year so far, where the US dollar has rallied up about 15% against the US yen. Now, not to blow my own horn, but of course, if you've been following me, you know that I called for this to happen over the last few months. In fact, for over a year, I've been saying that this would likely happen. So it's good to see that it's finally done it. This has, of course, been a market update for Trading Pursuits. May I wish you profitable trading.